A very good morning, everyone. It's really great to see a lot of our old friends here today. And I think this event seems to be an annual gathering for a lot of our seasonal investors. Now, at the same time, I'm also seeing a lot of new faces. Just a quick introduction about myself. My name is Jerry. I'm from the FSMOne Managed Portfolio team. And to all my old friends, I'm still Jerry in the brand new year of 2025. So I was told that I only have 15 minutes for my session today, but I really have plenty of information to share on FSMOne Managed Portfolio. So I will try my best to keep my sharing, my content concise. Just before I go into the key content of my today's sharing, a bit of a disclaimer here. I'll pause here for 2 seconds. So before I start the key content of my sharing for today's sessions, I just want to grab these opportunities to really extend our heartfelt gratitude to all the investors who have been showing support and trust on the managed portfolio. So over the past 1 year, the asset under management, we call it AUM, that our team is currently managing, have grown from less than 600 million as of end 2023 to more than 800 million as of end of 2024. And that's represent more than 40% of our growth rates over the past 1 year period. And that's truly a recognition and also a truly motivation to the team as a whole. And thankfully, without disappointing our investor, all our portfolios continue to deliver 2 consecutive years of positive returns after the very challenging year in the year of 2022. And particularly for our moderately aggressive and also our aggressive portfolio. These 2 portfolios delivered 2 years of double-digit return in 2023 and also 2024. And if you can see from the chart here, the red color line represents the aggressive portfolio and the blue color line represents the global benchmark. If you look at it, since we launched our portfolio in the year of 2017, our portfolio consistently beat the global benchmark on a much significant scale. And over the past 8 years, we have delivered 6 years of positive returns. But of course, today, my sharing, my content is not so much on the performance itself, because like I mentioned just now, we launched our portfolio in 2017, about 8 years ago. But over the past 8 years, from time to time, we still receive questions like, for example, is this managed portfolio the right product for me? What's the team do exactly behind the scene? What's the value that I can get from managed portfolio? So I can't really tell you exactly whether it's the right product for you. It's a decision that made by yourself. But what I can share is the solution that we are providing to our clients, the problems that we are solving for our clients. So I'll make it into 3 main categories of key problems that we are actually solving for our clients. First one is about the understanding on investment, particularly if you're aware that on the FSMOne platform, we have plenty of investment ideas on a monthly basis. We have our monthly fund choice. Regularly, FSMOne also carry out some promotional campaign from time to time. We do promotion for technology funds because we think the outlook for technology sector tends to be better, like what Kevin has just shared just now. He told you about how great is the outlook for technology. But if you take a step back and think about it, yes, FSMOne told me that the technology sector's outlook is so promising. But to me, as an investor, what should I do? I should buy into technology, but how much should I allocate to technology fund, for example? If I have 100,000 of capital, how much out of this 100,000 I should allocate into technology? And in another situation, if let's say 2 months ago, I have already bought into technology funds, and currently I'm sitting at, because of the recent pullback in US equity market, I'm currently sitting at, let's say, 8 to 10% kind of losses. What should I do as a retail investor? Should I continue to top up because of this promotional campaign? I can get a much lower sales charge to buy into technology fund. But if I bought into it, again, will I be overexposed to technology sectors. So if these are some of the questions that keep on popping up in your mind. Do not know how to construct your portfolio, do not know how to allocate into particular sectors. Managed portfolio is something that can solve your problem. The second thing, lack of time. I understand that a lot of our seasonal investors here today, some of you are even more experienced than me, because I always get the joke. In Mandarin, there's one term, people will always joke with me that, Jerry, the salt that I eat is more than the rice that you eat. I mean, that's true. We have a lot of seasonal investors who are more experienced than me here today. But I also understand many of you have your own business to manage. Many of you have your full-time job. That's why the questions that you need to ask yourself is really, how much time could you really allocate to monitor and also manage your portfolio? Because don't forget, if you look at the past 6 to 7 years, due to the advance in technology, due to internet, the transmission of information is getting so much faster. And I think the time and also room that left to us to react to all this information is actually getting shorter and shorter. That's why active management is something very important. And on top of it, besides the so-called market factors, on a product level, for example, a departure of a fund manager from Fund A to Fund B, and also some change in investment strategy. These are also factors that require investor reaction and also some action taken on your investment portfolio. And that's why I think the 10, 20 years ago, the so-called strategy of buy and hold it for 5 years and 10 years because they're so-called professional fund managers manage for me. I think that strategy at the current situation is actually putting yourself at a very high-risk environment. The third part, this is something that I feel is extremely important to a lot of the investors. And if you ask me today, to be very honest, to be frank, I don't think any one of us in the investment team, we are so much smarter than our investor. I really don't think so, because of the availability of information on the internet basis. Information is everywhere. It's unlike 10, 20 years ago where you couldn't really get much information. Nowadays, information is so cheap. It's so easy for us to get information on an internet basis. So I really don't think anyone from the investment team is smarter than a lot of the clients. But what I can assure you is that our team will be able to make a more rational and not emotionally driven decision. And I think I would like to quote a statement from one of the clients that I met last month in one of the events in Penang. He mentioned, and I quoted, he said that, Jerry, I understand that your team can make a more rational decision. And the key reason is because the money that you are managing is not your own money. And that's exactly right, because if you think about it, when investors are managing their own portfolio, I give you a few situations. We always say that theoretically, we should buy low and sell high. But how many of us can really perform the buy low and sell high? Just a very simple example. The sales on the FSMOne platform in 2022 is one of the lowest point. That's exactly the low point, but in fact, people are not buying. And the other thing is about making the decision of that against your emotion. For example, imagine today if you bought into a fund that lost, let's say, for example, 40 to 50%. How many of the investors will really take on the action to cut loss? Because in most of our mind, what we will think is that as long as I don't sell, I'm not realizing the losses. It's just a paper loss. What? I don't sell it, I just keep it, hope one day it will come back. But don't forget, the amount of money that you still left in the investment, there's opportunity cost behind of it. Let's say if you invested 100,000, left 50,000. The 50,000, if you can put it in somewhere else to yield you a much higher return, that's the opportunity cost. And you shouldn't be putting it in a product or in a fund that you think the outlook is not as promising. And that's exactly what our team do. Because from time to time, we are actually evaluating some of this opportunity in the global market. As and when we think it's right for us to make the action, we will do the most rational action. Don't get me wrong, I'm not saying that we will make all the decisions right most of the every time, because I think no one can assure you that the decision that they make will always be the right one. What we can assure you is that that decision that we make for the portfolio for our clients will always be the most objective and rational at the point of making the decision. So I think if these are the three key problems that have been disturbing you, that has been the problem that you have been facing all this while, it's really time for you to take a step back and really seriously consider about adding the so-called managed portfolio into your investment holding. Just a quick snapshot of the process of our managed portfolio. I think there's a lot of jargons here. I don't really want to go into very details about what we do on a daily basis, on a monthly basis, but I would like to split it into 4 steps. First, second, third, and fourth step, right? If you look at the first step, it's in a more layman term. We look at the global structural trend. So this is the step where we are trying to identify what is a structural trend in the global market over the next 5 to 10 years. And that's where we form the strategic allocation for our investor. And this is something that we have just changed last year. If you recall, or some of you attended our recommended fund event, I think in some of the sessions, my colleagues Paul has also shared about the change in methodology for us, because we realized that there's a change in the global structural trend. We actually changed our methodology from the previous so-called MSCI GTP weighted to MSCI ACWI. So that's a change in strategy, in the method, in strategic allocation that reflect our view on the global structural trend. Move on to the second step. This is more of a tactical view. So once we form our long-term view on the global markets, tactically from time to time, you need to make some changes to the markets, because every year there will be different factors, there will be different risks that in each of the markets that we are in. Currently, we have more than 35 investment professionals that sitting on our global, in the global presence in Hong Kong, Singapore, China, Malaysia. So these investment professionals, they are covering about 13 countries and regions, as well as 5 global sectors. So what we will do is that on a yearly basis, we will actually assign some of the outlook for the market. Like for example, those outlook that Kevin had just presented. If you look at it, most of the investment key ideas that Kevin presented, most of it will actually reflect in the strategy of our portfolio. That's also reflect the alignment between our regional research team and also the portfolio strategy. So that's why if you look at it, this tactical positioning is more for a short to mid-term kind of a strategy over the 1 to 2 year kind of a level. And the third one is about product selection. I realize that ETF, exchange traded fund, is getting more and more popular recently, because people are saying that it's more efficient, it's more cost effective to use ETF to invest. But if you all realize that in some of the market, yes, no doubt. That's why in our portfolio, we're actually adding more and more exposure to ETF. I think right now in some of our portfolio, we even have more than 20% of our exposure to ETF. But not all markets is the right markets to use ETF for our exposure. So in most of emerging markets, Asian, ASEAN equity, Malaysia equity, those are the markets that we still use actively managed fund to gain exposure, because that's where we find there's still plenty of room for the fund managers to generate alpha for our portfolio. That's why with a combination of an ETF and the unit trust fund, we think that that's really the right combination for our investor. Lastly, the ongoing monitoring and also management, and this is something that always that the questions that I always get. Investors will usually ask us, especially when there's no changes, no rebalancing in the portfolio for about 3-4 months, right? Investors will start questioning, are you all working? Or you just sit back and relax, not looking at the portfolio. To be honest, I summarize into 4 categories of the situation where we will start making changes or rebalancing for our portfolio. So the four situation is actually shift in global structural trend, right? Something that happened in last year where we think that it's right for us to adopt a new methodology. Some tactical view, some change in tactical view. For example, we like Malaysia more. We will add more exposure to Malaysia. For example, that's happened in end of 2022. We have been added more exposure to Malaysia. We think that we are quite bearish on China back in end of 2022. We actually cut our China exposure. We added more exposure to technology and US back in end of 2022 as well. And just recently, as what Henry mentioned, China has been identified as one of the dark horse for the year of 2025. we have also added China equity, one of the small cap China equity into our portfolio early of this year. We just done the rebalancing a couple of weeks ago. Yeah, so that's exactly the two things. And the third one is actually on a product level. As and when we think that a change in fund manager for a particular fund require us to react to it, we will actually change the fund. So these are the three situations, and the fourth one is actually on our asset allocation. For example, our target allocation for technology is 10%. If market moved too much, technology went up way too much, to about 13-14% in the portfolio allocation, that's where we will actually trigger rebalancing to rebalance the allocation back to the target level. So these are the four situations that we will be conducting and carrying out changes and rebalancing in our portfolio. I would like to quote one famous quote from Charlie Munger, which is, in investing, less is often more. I mean, I know it's part of this quote is referring to the holdings of the investment, but I'm referring to the action that we are taking for the portfolio. Some investors will expect us to do a more frequent. The frequent might be weekly, monthly kind of changes. For us, if we are making too frequent changes to a portfolio, it might not be good for investors. So what we think is that a more necessary changes to the portfolio when it is required, that's the most effective way of managing the portfolio. And to emphasize again, a decision that being made to be status quo, means not making any changes, is actually still a decision, because it still requires the team to do all the research analysis behind and to come to a conclusion that we should be status quo. We should not be making any changes for this month. So that's why sometimes less is often more. Before I come to the end of today's sharing, I just want to share these numbers, these figures, 83%. I'm looking at some of the faces, your eyes and mouth is opening quite big. It's not the numbers that's showing you that the expected return of the portfolio for the next couple of years. But if you have been using some of the trading platform out there, usually you will see some of the numbers as a reminder to investor. 60%, 70%, 80% of the clients who have been trading on, for example, CFD or any leverage product, these are the percentage of clients who are losing money in their account. But in FSMOne, as our vision suggests, we aim to help our investor to invest globally and profitably. We are proud to say that 83% of the FSMOne managed portfolio investor are actually enjoying a positive returns. To end my presentation, I would like to suggest these words as a key takeaway for everyone. In life, we really have limited time, limited resources, and that's where we need to start to live smartly, start leveraging on other expertise, start leveraging on other time to perform some of the tasks that we might not be able to perform. And I think FSMOne managed portfolio, there's so much of value that we are providing to our investor. If just now the three problems that I mentioned is really some of the problems that you are facing, that you are, it's some of the problems that have been disturbing you for quite some time, take some time to look at the managed portfolio. If you have any questions, our team, our investment team, we are actually stationed at the end of the corner there, outside there. Feel free to draw off to the booth area and look for us if you have any queries. So with that, I'll come to the end of my sharing today. Thank you so much.